Thanks a lot for the invitation to speak at the 22nd Annual Minsky Conference. Professor Minsky devoted his career to emphasize the connections between the financial sector and the real economy. It is safe to say that the events of the past decade have provided strong evidence in support of Professor Minsky's basic belief in the importance of those connections. Indeed, as the economy continues to improve, we are beginning to hear new concerns being voiced about potential financial instability and associated risks to the macroeconomy. In my talk today, I will provide some perspectives on those issues. I start by arguing that over the past 6 years, we have seen dramatic changes in the demand for and the supply of safe assets. Given those changes, the Federal Open Market Committee, the FOMC, is only able to achieve its congressionally mandated objectives of maximum employment and price stability by keeping the real, that is net of inflation, interest rate well below its 2007 level. I suggest that these changes in asset demand and asset supply are likely to persist over a considerable period of time, possibly the next 5 to 10 years. It follows that the FOMC will only be able to meet its objectives over that time frame by taking policy actions that ensure that the real interest rate remains unusually low. I then point out that low real interest rates can be expected to be associated with financial market phenomena that are seen as signifying instability. It follows that, for many years to come, the FOMC will only be able to achieve its congressionally mandated objectives by following policies that result in signs of financial market instability. Finally, I discuss how the FOMC should take those signs of instability into account when formulating monetary policy. Before proceeding, I need to stress that my remarks today reflect only my own views, and they're not necessarily those of any other FOMC participant. So I'll begin by going over some basics that are familiar to I think, virtually everyone in this room. An economist generally distinguish between nominal and real interest rates. The nominal interest rate is the interest rate reported on a typical savings account or mortgage. It tells you how many dollars a saver or a lender will get in the future for giving up $1 today. The real interest rate adjusts those future dollars for the anticipated rate of price increases. That is, for the anticipated rate of inflation. This means that the real interest rate tells you how much purchasing power a saver or a lender will get in the future for giving up $1 of purchasing power today. Economists generally believe that households and businesses make savings and investment decisions based on real interest rates over the next 5 to 10 years. So when I was a student back in the 70s and 80s in Professor Blinder's class, the real interest rate was a somewhat mysterious, unobservable object. That's no longer true. Treasury inflation-protected securities, bonds that are colloquially called TIPS, make coupon payments that are indexed to the inflation rate. This indexation means that TIPS coupon payments provide a fixed amount of purchasing power to the bondholder, not a fixed amount of dollars. As a result, TIPS yields provide a useful measure of the real interest rate. When we look at TIPS yields, we see that real interest rates have fallen dramatically over the past 6 years. In the first half of 2007, 5-year TIPS bonds had a real yield of about 2.5%. 10-year TIPS bonds also had a real yield of about 2.5%. Now, jump forward to 2013. The 5-year real TIPS yield is around negative 1.3%. Now, let's just be clear what that means. The purchaser of a 5-year TIPS bond is giving up $100 of purchasing power today in exchange for around $94, that is $6 less of purchasing power in 5 years. Now, even if you go out to 10 years, the 10-year real TIPS yield is also negative, around negative 0.7%. Now, why have real interest rates fallen so much? At one level, the answer is obvious: monetary policy. The FOMC has announced its intention to keep the Fed funds rate near zero until the unemployment rate falls below 6.5%. At the same time, the FOMC has bought over $3 trillion of longer-term assets issued or backed by the government. With inflationary expectations well anchored, that's an important clause, these actions are designed to push downward on real interest rates and have been successful in doing so. But I think this obvious monetary policy answer is actually deeply misleading. Consider the following very Minnesota analogy. Some days during the year when I go outside, I wear a parka. Other days, I wear a light jacket. And this will actually seem hard to believe, and it seems hard to believe now in this longest of winters. On some other days, I don't even need a coat at all. Every morning, I have complete control over what kind of coat I choose to wear. Even more control, than the FOMC has over real interest rates. But of course, in making my choice of outerwear, I'm merely responding to the Minnesota weather, which is a force that is, very sadly, well beyond my control. And I have this italicized in my written document. I don't know how to convey it with this. I don't know how to italicize it in a speech, but I'll say this. The FOMC is exactly the same position of having to respond to strong forces well beyond its control when it's making its decisions about the real interest rate. Thus, when I decide what coat to wear, my goal is to keep myself at a temperature that I view as appropriate, given prevailing conditions that I cannot influence. Similarly, when the FOMC decides on the level of the real interest rate, its goal is to keep the macroeconomy at an appropriate temperature, given prevailing conditions that it cannot influence. More concretely, the committee is taking actions to adjust real interest rates so as to fulfill its congressional dual mandate of promoting price stability and promoting maximum employment. So, for example, suppose the economy is running too cold in the sense that inflation is below the committee's 2% target and unemployment is elevated. Then the FOMC can, metaphorically, put on a heavier coat, that is, lower the real interest rate to stimulate spending and stimulate economic activity. If we go back to 2007, the FOMC had on about the right kind of coat in the sense that its macroeconomic outlook was broadly consistent with the committee's objectives. The fall in TIPS yields over the past 6 years suggests that the FOMC has, in the language of my metaphor, put on a warmer coat by pushing down on real interest rates. Indeed, there are some observers who have expressed the concern that the committee has in fact put on too heavy a parka, given the conditions. But the truth is that the FOMC's choice of winter garb is actually insufficient to keep the U.S. economy appropriately warm. After all, the outlook for both employment and prices is too low relative to the FOMC's goals. Unemployment is currently 7.6% and is expected to fall only slowly. At the same time, inflation pressures are muted. Both private sector forecasters and the FOMC expect that personal consumption expenditure inflation, PCE inflation, will be at or below 2% through the next 2 years. The committee needs to put on some more serious winter gear if it is to get the economy back to the right temperature. More prosaically, the FOMC can only achieve its dual mandate objectives by lowering the real interest rate even further below its 2007 level. So I've argued that the path of real interest rates that is consistent with the FOMC's dual mandate objectives, what one might call the mandate-consistent path of real interest rates, has fallen greatly since 2007. So in 2007, real interest rates were 2.5% over the next 5 years, 2.5% over the next 10 years, and that was broadly consistent with the FOMC's objectives. Now they're much lower, and they're still too high relative to the FOMC being able to achieve its objectives. I now turn to a discussion of why this has happened. I see the decline in mandate-consistent real interest rates is grounded in an increase in the demand for and a fall in the supply of, so an increase in the demand for and a fall in the supply of safe financial investment vehicles. And importantly, I see these changes as likely to be highly persistent. So we talk first on the demand side. And there's just many factors underlying the increased demand for safe assets. And I'll just emphasize three that strike me as particularly important. The three I'm going to talk about are tighter credit access, heightened perceptions of macroeconomic risk, and increased uncertainty about federal fiscal policy. So we start with credit access. I don't think that it's controversial to say that credit access is more limited than in 2007. What is less generally realized, I think, is that when you put restrictions on households and businesses' ability to borrow, that typically leads them to spend less and save more, to want to hold more safe assets. Let me try to illustrate this point through an example. Think about a household that wants to buy a house. In 2007, that household could have received a mortgage with a down payment of 10% of the purchase price, possibly even lower. In 2013, that same household is considerably more likely to need a down payment of 20%. These tighter mortgage standards mean that to buy a similarly priced home, the household needs to first acquire more assets. And this is just one example of a much more pervasive phenomenon. So this is one reason why I see the demand for safe assets as having risen, because of tighter limits on credit access. It's also risen because of households and businesses' assessments of macroeconomic risk. As of 2007, the United States had just gone through nearly 25 years of macroeconomic tranquility. As a consequence, relatively few workers or businesses, or macroeconomists, in the United States saw a severe macroeconomic shock as possible. Now, in the wake of the Great Recession and the not-so-great recovery, the story is a different one. More workers see themselves as being exposed to the risk of persistent deterioration in labor incomes. More businesses see themselves exposed to the risk of a radical and persistent downshift in the demand for their products. These workers and businesses have an incentive to accumulate more safe assets as a way to self-insure against this enhanced macroeconomic risk. So the first two things I wanted to talk about, tightened credit access and a heightened perception of macroeconomic risk. The final source of uncertainty I'll emphasize, final source of extra demand, I should say, is in terms of the federal fiscal situation, which is another key source of elevated uncertainty. The federal government faces a long-run disconnect between its overt commitments and the baseline path of federal tax collections. This disconnect can only be resolved by raising taxes and/or cutting the long-run arc of spending. Now, this tension between revenues and expenditure predates the 2007 downturn, long predates it. But it's at least arguable that the fiscal debates of the past few years have made more Americans aware of the uncertainties associated with resolving this long-run disconnect. These uncertainties, again, affect the demand for safe assets. For example, on the business side, the prospect of higher future corporate profits taxes gives businesses an incentive to demand safe short-term financial assets as opposed to engaging in long-term investments. On the household side, so that's the business side, I emphasize the possibility of an increase in taxes. On the household side, the prospect of a reduction in Medicare, Medicaid, or Social Security gives some households an incentive to demand more safe assets as a way of replacing these lost potential benefits. So whether you're thinking about cutting benefits or raising taxes, both of those can have an increase in generate an increase in demand for safe assets. So that's all on the demand side. due in part, and these are three, I think, as I suggest, many factors. Part to tighter credit access and higher uncertainty, the demand for safe financial assets has risen since 2007. Now, at the same time, on the supply side, the global supply of assets perceived as safe has also fallen. Americans and many others around the world thought in 2007 that it was highly unlikely that American residential land and assets backed by American residential land could ever fall in value by 30%. Similarly, investors around the world viewed all forms of European sovereign debt as a safe investment. Neither of these statements are true anymore. So the FOMC is confronted with a greater demand for safe assets and a tighter supply of safe assets than was true in 2007. Now, what these changes in asset markets mean is that at any given level of real interest rates, households and businesses spend less. Their decline in spending pushes down on both prices and employment. And as a result, the FOMC has to lower its real interest rate in order to achieve its objectives. Now, I often hear, go around giving speeches, I often hear questions or comments to the effect that the FOMC has created a low interest rate environment that is harmful for savers and others. But to return to my winter wear analogy, this seems about as compelling as blaming me for creating winter in Minnesota by putting on my long johns. The FOMC has been confronted with wintry changes in asset demand and asset supply. It has lowered the real interest rate to keep the economy warmer in light of these changes. Indeed, as I suggested earlier, the weak macroeconomic outlook suggests that the FOMC has in fact not put on a warm enough coat. That is, it has not lowered the real interest rate sufficiently. So that's where we are. What about the future? The passage of time will, I think, ameliorate these changes in the demand for and supply of safe assets, but only partially. Now, any long-run forecast, and any short-run forecast for that matter, but it's even more true of long-run forecasts, has enormous attendant uncertainties. But I do expect that for a considerable period of time, credit market, possibly the next 5 to 10 years, credit market access will remain limited relative to what borrowers had available in 2007. I expect that many workers and businesses will remain more concerned than in 2007 about the risk of a large adverse recessionary shock. And I also expect that businesses will continue to feel a heightened degree of uncertainty about taxes, and households will continue to feel a heightened degree of uncertainty about the level of federal government benefits. These considerations suggest that for many years to come, the FOMC will have to maintain low real interest rates in order to achieve its congressionally mandated goals. Okay, so that's my first main message, is that, given the changes in asset markets, that's what's forced the FOMC to have to lower real interest rates in order to achieve its goals, and that is that phenomenon of those changes in asset markets likely to be persistent, so the FOMC will have to maintain those low real interest rates. Now, I've talked about that the FOMC will have to keep the time path of real interest rates lower than in 2007 in order to achieve its dual mandate outcomes. And indeed, I think we have to think about magnitudes here. Remember that in 2013, the mandate-consistent real interest rate over the next 10 years is at least 3 full percentage points lower than it was in 2007. It seems likely that the mandate-consistent time path of real interest rates could be unusually low for a considerable period of time. Moreover, these unusually low real interest rates will likely be associated with other unusual financial market outcomes. I'll discuss 3 of these outcomes in some detail. Inflated asset prices, unusually volatile asset returns, and high merger activity. The first consequence of low real interest rates that I just mentioned, higher asset prices, is in some sense the most obvious. Long-lived assets are somewhat substitutable for each other. So investors generally respond to low real TIPS yields by bidding up the price of other long-lived assets, be it gold, land, stocks, or machines. That means that when real interest rates are unusually low by historical norms, asset prices will typically be unusually high relative to historical norms. The second consequence of low real interest rates is that asset returns should be expected to be highly volatile. When the real interest rate is very high, only the near term matters for investors. So variations in an asset's price only reflect changes in investors' information about the asset's near-term dividends or risk premium. When the real interest rate is unusually low, then an asset's price will become correspondingly sensitive to information about dividends or risk premia in what might seem like the distant future. This new source of relevant information should be expected to induce more variability into asset prices and asset returns. Finally, I believe that when real interest rates are low, we should expect to see more mergers. Now, the reason I say that is mergers typically involve enduring current costs in exchange for a flow of future benefits. For example, to initiate a merger, the acquiring firm has to search for an appropriate target. And that search can be costly. As well, after the merger, it may be necessary to undertake a one-time costly reorganization of people and materiel to achieve the anticipated gains in revenue. Businesses will be more willing to pay the upfront cost of a merger in exchange for the anticipated flow of benefits associated with that merger when the real interest rate is low. And it's because you're discounting those future benefits by a lower real interest rate. So in this way, unusually low real interest rates should be expected to be linked with inflated asset prices, high asset return volatility, and heightened merger activity. All of these financial market outcomes are often interpreted as signifying financial market instability. And so this observation brings me to my second key conclusion. I've suggested that it's likely for a number of years to come, the FOMC will only be able to achieve its dual mandate of maximum employment and price stability if it keeps real interest rates unusually low. I've also argued that when real interest rates are low, we are likely to see financial market outcomes that signify instability. It follows that for a considerable period of time, the FOMC may only be able to achieve its macroeconomic objectives in association with signs of instability in financial markets, signs like inflated asset prices, like volatile asset prices and returns, and heightened merger activity. So those are my first two messages. Let me turn to my final point, which is about financial stability and monetary policy. So I've talked about various financial market phenomena, inflated asset prices, high asset price volatility, and heightened merger activity. These financial market phenomena could potentially pose macroeconomic risks. Now I'll start off by saying these potentialities are best addressed, in my view, through effective supervision and regulation of the financial sector. Nonetheless, it is possible that these supervisory and regulatory tools may only partially mitigate the relevant macroeconomic risks. How, if at all, should the FOMC adapt its monetary policy in response to any residual risks after the application of these other tools? To answer this question, the committee will confront an ongoing probabilistic cost-benefit calculation. On the one hand, raising the real interest rate will definitely lead to lower employment and prices. On the other hand, raising the real interest rate may reduce the risk of a financial crisis, a crisis which could give rise to a much larger fall in employment and prices. So the committee has to weigh the certainty of a costly deviation from its dual mandate objectives against the benefit of reducing a probability of an even larger deviation from its objectives. Now, as I talk about this probabilistic cost-benefit calculation is conceptually challenging today. It's going to remain so for some time to come. But it is important to stress that the committee is in a better position, and I would say a much better position, to address this challenging question in 2013 than it was in 2007. The Federal Reserve System now dedicates a significant amount of our best staff resources to financial system surveillance. In fact, the Federal Reserve Bank of Minneapolis contributes to these efforts in a number of ways, including our ongoing monitoring of the risk-neutral probability distributions of future asset values. As a result of these efforts, the FOMC has a lot more information on an ongoing basis about the extent of financial system risks. Nonetheless, as always, there is more to be learned. We need to understand better, in light of the current state of supervision and regulation, which residual financial system risks have the potential to translate into macroeconomic risks. And we need to understand better to what extent monetary policy tightening can in fact temper those residual financial system risks. Let me wrap up, and I'll be happy to take your questions after that. Over the past 6 years, there have been big changes in the demand for and the supply of safe assets. These changes seem likely to be persistent ones. They mean that the FOMC may keep real interest rates unusually low for years in order to achieve its objectives of maximum employment and price stability. It follows that to attain the goals of maximum employment and price stability over that same long period of time, Americans will likely face the consequences of low real interest rates. I've emphasized consequences related to financial market instability, like inflated asset prices, volatile asset returns, and heightened merger activity. Even in the presence of effective supervision and regulation, these phenomena could pose residual macroeconomic risks. And the FOMC's decision about whether to respond to those residual risks using the rather blunt tool of monetary policy will necessarily depend on a delicate, probabilistic cost-benefit calculation. Thank you very much for listening. I look forward to taking your questions.